What's going on, profiteers? Hope all is well. Another wonderful episode of Combos with the CFP, Mario Payne here in sunny Florida. But before we get started, like, share, subscribe to our channel, Painful Profits. We make profits. They can be painful sometimes, but they are profits. And talking about profits, before we get started as well, go to the New York Stock Exchange on your Robinhood, LetBob, or any other app that you use to invest, and check out our ETF, LetB, LETB as in boy, the third black-owned ETF ever on the stock market, and the first that's fully automated. Automation is the key, and we know that. Also, of course, we have our investment app as well, LetBob, LETBOB, the first black-owned money management app ever. So it's pretty cool, man, and it's free. But the great thing about it, you try to invest the money, well, Bob got you. So you can allow Bob to invest the money when it's the best time to invest. And you get notifications with your favorite stocks as push notifications. So it's pretty cool because it's all about automation. Now, who did not automate properly and who did not get their things in order was First Republic Bank. Oh, as you guys know, it failed. The third bank this year to fail. So I wanted to talk about today how First Republic Bank failed. What did they actually do to fail? Number two, is this an anomaly, right? Anytime we think about a bank failure, oh my gosh, the sky is falling. It's going to be horrible. All banks are going to fall. Actually, believe it or not, over the past 13 years, it's been 564 different banks that failed. Now, some banks get more press than others, and anytime a bank fails, it's not good, right? It's some uncertainty with the people that have their money in that bank. But of course, you have FDIC insurance up to $250,000 to help us. The FDIC actually came out and said anything over that they're going to take care of, even though JP Morgan now is taking over that bank, which we'll talk about. And also, you don't want to see people's jobs go away either. But it is all good at the end of the day. But it's also kind of a juggling act, right? We're going to talk about how us as day-to-day budgeters, balancing our checkbooks, can take some signs of First Republic Bank and don't do the same thing that they did. Now, yeah, they had billions of dollars, but it did some things that they could have just did a better job of, which we'll talk about. And also from an investment standpoint, how can we profit off of things going down from a banking standpoint? Because the regional banking sector as a whole is down by 30% this year. $100,000 in that sector, that ETF, is now $70,000. So as a new investor, yes, it might take a year, 2, 3 years for those regional banks to get back to where they were, but ain't nothing wrong getting 10% a year for 3 years. Ain't nothing wrong for getting 15% a year for 2 years. So we'll talk about that. But let's first start with First Republic Bank. Look below. As we go to Wikipedia, First Republic Bank is a commercial bank and a provider of wealth management services headquartered in San Francisco, California. It catered to high net worth individuals. They had 93 offices in 11 states, primarily in New York, California, Massachusetts, and my state of Florida. May 1st, 2023, part of the 2023 banking crisis, the FDIC announced that First Republic had been closed and sold to JP Morgan. So shouts out to JP Morgan for taking the bag, even though they got it for like 25 cents to the dollar. Jamie Dimon, CEO of JP Morgan, man, keeps on rocking and rolling. Investment that literally was $100 2 years ago, now is at 25. They're going to make their money. Believe you me. JP Morgan going to make their money. Also, we go below again, as we can see, their revenue in 2022, $6.7 billion would it be. Their assets, $212 billion would it be. Total equity, $17.4 billion would it be. Number of employees, not fun, over 7,000. Now, prayerfully, they'll be able to get hired within JP Morgan. They'll be restructured somewhere inside of JP Morgan so they don't lose their job. No fault of their own, but a big bank, right? A big bank. So is the sky falling? No. Look at this from the FDIC. And the FDIC stands for Federal Deposit Insurance Corporation. Very important. The FDIC is not the federal government. People think that the FDIC is actually the federal government. It's the Federal Deposit Insurance Corporation. It is a company that's backed by the federal government. Each time we put money to the bank, some of our money is going to the FDIC. All banks have to put money to the FDIC. Have this big fund to make sure we protect banks in this instance. So again, FDIC, not exactly the federal government, but they're backed by the federal government, right? It's like we got a bodyguard. You know, you're walking around, you're doing good, you got a bodyguard, you're rocking and rolling. You're backed by that bodyguard. The FDIC is the bodyguard for our pockets when it comes to banks. But look here, though. As we can see, from 2021 to 2023, we have had a total, scroll down, Mario, scroll down. We've had a total of 564 bank failures from 2001 to 2023. Spiked up, crisis of 2007, 2008. And man, let me tell y'all, I started practicing in 2007. Man, you want to talk about feet to the fire. 2008, 2009. That was crazy. I was like, man, this is the career of a financial advisor. Of course, things got better. But man, I learned early. It's good to be diversified. It's good to be risk off when it comes to investing clients' money, right? Risky investors might make more money, but that bag goes down a lot quicker. So I learned my lesson very, very quickly from seeing other financial advisors in my first firm I worked for before I started my own practice, that you want to be diversified. So as you can see, bank failures, and also, right, we've had 4 bank failures in 2020, 4 in 2019, none in 21 or 22, but 3 so far in 2023. So I say that to say, that's like a double entendre, right? This happens. Now, it doesn't happen every single day, and the news concentrates on it more sometimes than not sometimes, depending on what's going on in the media and in the world. But this happens. The sky's not falling. Yes, this bank in particular made some bad choices, but this happens per the FDIC. Now, First Republic Bank failure. What did they do wrong? What did they do wrong, Mario? Well, here we go. Key background from Forbes, right? The target federal funds rate, which sets the cost of borrowing between banks and determined by the Fed, sits at 4.75 to 5%, nearly a 20-year high from 0% March 2022. Now, this actually came down. It was almost at a 40-year high 2 months ago. So what happened is like an anomaly, right? 40 years ago, the Fed had rates this high. It just does not happen. But from a protection standpoint, First Republic Bank, they was not protecting their money. Us as budgeters, checking our pocketbooks on a day-to-day basis, doing our budget, what's coming into our pocket, out our pocket. We do not want to get over leveraged for that rainy day, right? We don't want to just be spending money to be spending it. We always want to have money for a rainy day, and they did not do that. Let's see. High interest rates makes banks' cost of doing business much steeper. And the failures of First Republic, Silicon Valley that failed as well, and also Signature Banks, the 3 that failed this year. Common thing can largely be traced by their ill preparedness for changes of rates. The balance sheets of these 3 failed banks shared a vulnerability to rising rates that exceeded most of the regional banks' competitors. So, long story short, they were used to being able to borrow, right? If I got $100 million, I borrow and I ain't paying nothing back, I'm good with that. Now at $100 million, it takes 5% to pay it back. Well, that's $5 million of interest. Now we think about on the billions, right? Now it's $1 billion. I'm not paying nothing back at 0%. Now that $1 billion at 5% is a big number. 50 million, that's gonna hurt you. Especially then when your investments are not paying out, because we know bonds are down, interest ain't paying. They had some riskier assets, and you couple that with not being able to have free money anymore, and down, baby, Low Street, Nelly style, right? So what does that say? That says us, let's not be like First Republic. Things are going good at the job, save more money. Things are going good with our investments, pocket some of our gains. Put some of my money in the cash part of our portfolio. Be diversified. Don't have all your money or even half your money in aggressive investments. I always say to my clients, right? 80 to 90% should be in more conservative type investments. The other 10% are the more riskier investments, right? No more than 2% in Bitcoin, no more than 2% in gold and silver, right? Large cap investments, value investments. Now, yes, we can buy things at a low price and sell them at a high price. We can, quote unquote, trade from a long-term standpoint, not trading on a day-to-day basis, but buying something like Tesla a few months ago that was down by 20% and then selling when it's high. We can do those types of things with large companies, right? Amazon, Facebook. Imagine we bought Facebook 6 months ago, right? You doubled your money. Sell it, wait till it goes back down. We can do those types of things, but aggressive investments, no more than 10%. And that's what happened to First Republic Bank. So as investors, how can I profit off of this? Well, again, hopefully the people with First Republic, Silicon Valley and Signature, those employees, they get back on their feet and they get jobs, because we don't want to see anybody not being able to provide for the family. But as investors, what can we do? Let's look here. Well, it is an ETF called IAT. Not recommending this as a certified financial planner. I recommend stuff for my clients. For everybody else in the world, like a doctor, take the medicine, don't take the medicine, just giving advice. Not for you, just in general. But IAT, the iShares US Regional Banks ETF. Now this invests in regional banks. We have our large banks, Bank of America, JP Morgan Chase, Wells Fargo, the large banks. Then you have regional banks, right? Banks that like PNC, like Fifth Third Bank, like Silicon Valley, like First Republic. Still big, but they're not the largest of the large. They call those regional banks. And regional banks are the ones that gives us better interest rates on our loans. They're the ones we do our banking from for the most part, right? That's why, diversification-wise, the FDIC does not want all the smaller banks to fail, because then all the money goes to the big banks and there's no diversification. It's called a monopoly. We don't want that. So, Reg C here is down by 28.29%. On January 1st, 100,000 is now almost $70,000. Let's say it takes 2 years for it to get back to where it was, right? 2 years for everything to sort out. Well, that's 15% a year. If I buy it today, hold it, don't do anything, just let it get to where it's getting to, 70,000 is now 100,000. Pretty good, right? Almost doubling the market. Market average is about 8% a year. 2 years, that's 16%. Here, actually more than 16%, right? Because we buy something that's down by 28%. When it gets back up, that's actually a 36% gain. So you're actually making more than the market. Pretty good. So again, not telling you to invest into this, but if you want to be able to be diversified, not buying one bank, but buying a pool of banks, investments like this in regional banks that are all down. Some regional banks are doing better than, of course, Silicon Valley and First Republic. But to be diversified, this is what you want to look into. And finally, as we scroll down some more key facts, portfolio specifics, but it actually breaks down the banks. Does it? Fees, holdings, there you go. And we can also see here what investments they pick from a regional bank standpoint. PNC, US Bancorp, Truist Financial, M&T Bank, where the Ravens play, Regions Bank, Fifth Third Bank, my hometown Cincinnati due to down the way, Citizens Financial Group, First Citizens, Key Corp, and others. That's why it's important when you invest to read your prospectus. I talked about that in my book, The Relaxed Investor. It stands in July. Very excited about that. But I've been rambling for more than 13 minutes. Want to give y'all some information. So again, First Republic Bank, they are down, taken over by JP Morgan. Prayerfully, the 7,000 employees get back on their feet with a job. As investors, look into something like this to take advantage of banks being down over the long term. And number three, in our pocketbooks, make sure you don't do what First Republic Bank did, right? Let's not be over leveraged. As we're making more money, let's make sure we put more in our savings, because a rainy day will happen. The rainy day happens, we want to make sure that we're able to pay bills with cash, not credit cards, not get into some mess. Because you didn't get bailed out by JP Morgan like First Republic Bank did. But hope all is well. Y'all stay blessed, man. And let's make some paper profits together, y'all.
And you just wanna get paid, making the money mistakes. Make a payment on your bills and you still late, yeah. Pay for profits to help you seek change, and you just wanna get paid, yeah. Tired of making no money mistakes. Make a payment on your bills and you still late, pay for profits to help you seek change, yeah. Cut the show and just listen. You wanna feel empowered by making money decisions. Residual by the hours can get you a better living. Bitch at the check, you knowing it could be different, you know.